Welcome back to Investing Talk Podcast.
Today, we're looking at Sellas Life Sciences.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. We are looking at really a high-stakes moment for Sellas. This is a company that I think represents the ultimate biotech binary bet.
Binary is the right word.
It really is. They're a clinical stage biopharma focused entirely on a very specific part of cancer immunotherapy. And their whole strategy is defined by one thing, targeting the Wilms tumor 1 antigen, or WT1.
I think we need to pause there on the WT1 antigen, because that isn't just a detail, that's their entire proprietary foundation. For anyone listening who might be newer to this space, why is WT1 such a critical target in oncology?
That's a great question. What's so fascinating here is that WT1 is a protein that is overexpressed, so it's produced in excessive amounts in a really wide range of cancers.
So it's not just in one type of cancer.
Not at all. It's strongly linked to hematologic tumors like leukemia, sure, but also a number of solid tumors. It acts like a unique flag on the cancer cell surface.
Okay.
So by focusing their immunotherapies on training the body's immune system to recognize and attack that WT1 flag, they're building a highly targeted treatment, one that potentially sidesteps some of the issues you see with broader, less specific immunotherapies.
That makes a lot of sense. It sounds like they have a specialized weapon aimed at a very common enemy signal. But specializing like that, it comes at a massive cost.
Yeah.
We have to be honest about the books here.
We do.
Because when you look at the financials of a company like this, I mean, it can be terrifying. We're talking about an entity that, by definition, has zero revenue right now.
It is terrifying if you look at it in a vacuum, absolutely. They're reporting deeply negative operational margins. If you look at the pre-tax income, it's over, 1,400% in the red? And the resulting PE ratio sits deeply negative. It fluctuates between, say, -15 and -18. But that number isn't a sign of failure. It's the exact price tag of pure, intense research and development.
They're buying the future.
They are buying future potential with present capital. Exactly.
So how do we look past those deeply negative numbers? Is the market simply, hoping? Or is there a genuine growth trajectory that analysts are pinning their faith on?
Well, the market is pricing in the success of the science. If we connect this to the bigger picture, analysts are projecting forward earnings growth of over 51% per year.
51%.
I know. That number is predicated entirely on the commercial launch of their key assets, but it shows you the scale of the market opportunity if these trials succeed. And on top of that, their latest quarterly results actually offered a small but positive signal.
Oh, really?
Yeah, a signal of execution. They reported a loss of 6 cents per share, which actually beat the consensus estimate of 8 cents. When you're burning cash that fast, every penny saved indicates strong, focused management.
That brings us immediately to the question of financial stability. If they are burning cash that intensely, where's the safety net? What happens if this pivotal phase 3 trial drags on longer than expected?
And that is where the balance sheet becomes their primary risk mitigant. And frankly, it's where the numbers get pretty surprising for a clinical stage biotech. They have exceptionally robust liquidity. We're talking about a current ratio of 8.3.
Wait, 8.3? That is massive. To put that in context, a ratio of 1 means assets equal liabilities.
Cool.
An 8.3 current ratio means they have over 8 times the assets needed to cover their short-term liabilities.
That's a huge cushion.
But in a biotech spending this heavily on R&D, doesn't that raise the question of whether they're sitting on too much capital instead of accelerating things?
That's a fair point, but in this specific sector, especially leading up to a binary readout, cash is king. It prevents the need for an emergency dilutive capital raise right before or, immediately after a key result. The market rewards that kind of discipline.
And the debt.
That financial stability is further underscored by minimal leverage. Their total debt-to-equity ratio is almost negligible, sitting at 0.01. They're basically funding their aggressive R&D strategy with equity and cash reserves, not debt.
And crucially, they recently topped up that runway, didn't they? That's so essential in an industry that's just defined by negative free cash flow.
It absolutely is. They executed a warrant exercise recently, which brought in approximately $31 million in fresh capital.
That's the runway.
That infusion is critical. It supports the ongoing phase 3 trials and provides an ample financial runway, which drastically reduces the immediate risk of further equity dilution. Investors don't want that overhang. So they've bought themselves time and flexibility.
Okay, so they have the financial stability to execute. That means we have to look at what they're executing on.
Yeah.
We talked about the WT1 platform being their moat. How does this proprietary IP translate into their actual pipeline assets?
Well, the WT1 IP protects them specifically in the acute myeloid leukemia, or AML space, against the big pharma players who usually come in with broader approaches. The pipeline highlights two key assets that really validate this target. The one everyone is focused on right now is Gelinpepimut-S, or GPS.
And that's the one in phase 3.
That's the one. It's in phase 3 for AML maintenance therapy.
So GPS is the heavy hitter, the one tied to this imminent binary event. But if GPS is the future, what about the other asset, SLS009? Does its performance lend any credence to the entire platform?
Precisely. You've hit on it. SLS009 is a CDK9 inhibitor, and its recent phase 2 data is perhaps the most important foundational element to the bull case, even though it's not the primary catalyst right now.
Okay, so what did that data show?
That asset showed a very promising 46% overall response rate when used in combinations for relapsed or refractory AML.
46% is a strong signal.
It's a very strong signal. That successful phase 2 data suggests that the underlying WT1 targeting mechanism, the platform itself, is biologically active and effective. It tells us the platform works, which makes the bet on GPS in phase 3 much more informed than just, a blind gamble.
Speaking of validation, that brings us directly to why all these numbers in IP actually matter right now. And that's the big trial readout. This is the definition of a binary event for Sellas.
It absolutely is.
The entire near-term investment thesis just hinges on the outcome of the phase 3 Regal trial for that GPS asset.
It is the single most important data point in the company's history to date. The primary trigger for them to unblind the data and do the final analysis is reaching 80 events.
And an event in this trial design is a death in the study population.
Correct. The endpoint they are measuring is overall survival, how long patients live.
So 80 deaths have to occur before they can measure the difference between the treatment group and the placebo group. It sounds grim, but it's standard protocol in these trials. Where are we on that count?
We have a very precise update that the market has latched onto. As of late December 2025, they had reached 72 out of the 80 required events.
So just 8 to go.
Just 8 to go, which means the market is on high alert. But here's where it gets really interesting and highly speculative.
Go on. Tell me. What's the read on the remaining 8 events?
Analysts who track trial flow have noted an observed slower death rate in the population recently.
A slower death rate.
Think about the implication of that. If the death rate is slowing down, meaning it's taking longer to reach those final 8 required events, it potentially suggests that the treatment arm, GPS, is prolonging patient lives more effectively than the control arm.
Ah, I see the connection. A slower event rate could translate directly into extended survival. And if that holds true when they unblind it, that strengthens the bull case immensely.
That's it. The market is essentially trying to read the tea leaves based on the speed of the event count, interpreting this delay as a highly positive signal.
They're betting on the operational dynamics translating into clinical success.
Exactly. And the implication is that the unblinding is imminent, potentially landing within the first quarter of 2026. This anticipation explains the frenetic price action we've seen recently.
That momentum has been incredible. The stock has been highly volatile, posting these aggressive single-day surges. We've seen, 11% to 17% gains in some sessions?
And it drove the stock to a new 52-week high of $4.80.
That kind of move requires serious conviction. It wasn't on thin air either. It was on heavy volume. Nearly 6 million shares traded in a day. That suggests large capital is positioning itself.
And the technical setup confirms that positioning. It's signaling what we call a deep accumulation phase. This isn't just retail enthusiasm. It's institutions and sophisticated traders building large positions ahead of the catalyst.
And what's the key technical signal?
What's compelling technically is the confirmation of a golden cross. For anyone listening, a golden cross is one of the strongest indicators of an established uptrend. It happens when a shorter-term moving average crosses above a longer-term one. Specifically for Sellas, the 50-day moving average, which was sitting around $2.03, crossed decisively above the 200-day moving average, which is around $1.90. This is technical confirmation that the rally is supported by long-term buying pressure, not just temporary noise.
So the chart is screaming buy the momentum, and the derivatives market, the options chain, is usually a great canary in the coal mine for institutional sentiment. What are the options telling us?
They are showing massive constructive momentum. We've seen options volume, specifically on the call side, running over 800% above average.
800%.
That level of unusual activity shows a widespread expectation of significant upside after the readout. People are essentially paying a huge premium to bet on a massive jump in the stock price.
And we also have to talk about the volatility inherent in this. This is not a stock for the faint of heart. The high beta of 2.26 tells you everything you need to know.
That high beta means the stock tends to move 2.26 times the movement of the overall market. We saw this exact kind of volatility in other oncology readouts a few years back, where a stock moved 20 or 30% in a single day.
A huge swing.
Huge. And while it swings hard on bad news, the potential for those fast, volatility-fueled gains, that asymmetric reward, is exactly what high-risk traders are chasing right now.
So when we connect all these data points, the technicals, the options, the imminent trial update, it sets a clear expectation of massive upside. What is the consensus target range from analysts if the Regal trial succeeds?
The analyst consensus is highly bullish. Price targets are ranging from around $6.83 up to $7.50.
And considering the stock was recently trading around $4.40, that signals an upside potential of 55 to 60%.
It's a powerful incentive. But what lends even more credibility than analyst reports, I think, is insider conviction.
I always look at insider buying. It's one thing for an analyst to recommend a stock, but it's another thing entirely for someone with intimate firsthand knowledge to put their own money on the line.
Absolutely. The company's director, Catherine Bach-Callan, recently demonstrated tremendous conviction. She purchased 63,400 shares, increasing her personal stake by over 150%.
150% increase.
That level of aggressive accumulation by a director, especially right before a key readout, is incredibly difficult to ignore. It suggests a belief in the outcome that goes beyond just a press release.
Okay, we've covered the entire bullish trajectory and the financial cushioning they have, but we have to bring it back down to earth and be brutally honest about the core risk. Why would anyone not invest in this right now?
The core bear case is simple. It's the binary risk. The potential for the blinded Regal trial unblinding to be negative or even inconclusive remains the single largest risk factor here.
It all comes down to the data.
It does. You can have the best balance sheet and the most aggressive insider buying, but if the clinical data fails to show a statistically significant benefit in overall survival, the stock price will correct severely and rapidly. This is the definition of a binary event. It's either a massive success or a massive failure with very little middle ground.
So all the mitigation we discussed, 31 million cash raised, the 8.3 current ratio, those only manage operational risks like cash burn. They do nothing to mitigate the clinical risk of the trial itself.
Correct. They buy operational stability, but they don't buy clinical success. The volatile pricing and the high beta we've been observing are a direct reflection of the market trying to balance this extreme risk-reward ratio every single day.
So let's synthesize this. What's the elevator pitch here? Why should people be paying attention to Sellas right now?
The key takeaway is this. The proprietary WT1 platform has been validated by positive Phase 2 data from SLS 009. That gives the whole thesis a scientific foundation. The company has secured enough liquidity to execute its plan without near-term dilution worries. And the stock is currently primed for explosive upside as the Phase 3 Regal trial results are imminent with only 8 more events needed.
And that slower event rate is what the market is clinging to.
Right. The perceived slower event rate suggests the market is leaning heavily toward a positive survival outcome.
It's a classic high-risk, high-reward situation. Given the significant upside projections and the very strong insider conviction we've seen, this raises an important question for you, the listener. How do you weigh the potential for that asymmetric reward against a clear binary risk presented by this imminent Phase 3 trial readout?
That's the key question.
Are you viewing this as a short-term swing trade, aiming to capitalize on the moment of unblinding? Or is the deeper potential of the WT1 platform itself worth positioning for a multi-year hold, targeting the much larger commercial opportunity post-approval?
A fascinating distinction to make. And remember, the potential of that WT1 platform goes far beyond just AML. If this mechanism is validated, it opens up enormous expansion opportunities into numerous other solid tumors where WT1 is expressed.
It could become a multi-indication powerhouse.
That's the real long-term thesis.
Something to mull over. Thank you for joining us for this analysis. Don't forget to subscribe for more insights into the companies and catalysts moving the market.